Hello, it's Jeffrey Christian of CPM Group. It's 10:15 on Friday morning, the 13th of September here in New York. I want to talk about gold and silver prices and where we see them going. I also will talk about economics and politics. They are intertwined one with the other, and also they are both very much important to gold and silver. I point out some things that both parties in the U.S. political system seem to be missing on that. Hopefully I can irritate a whole lot of people that way. But let's start by talking about gold. Gold and record prices yesterday, again today. The price of gold got over $2,601 for the active December COMEX futures contract this morning. It's trading around $2,955 as we speak. Silver prices got up to $30.50, 51 cents, I think. It's trading around $30.33 right now. I'll talk a little bit about where we go and why we're here, and then, as I said, get into some economics and politics. Just point out some things that might be interesting to people. So yes, gold prices are at a record level. They shot up very sharply this morning. Gold prices, silver, platinum, palladium all shot up. Oil not so much. Copper already has risen very sharply earlier in the week. Stocks and bonds also rose very sharply. And it's not just gold and silver that are rising. And what we're seeing are expectations of lower interest rates sooner. If you go back 2 days ago and look at the Fed watch data, the probability, the bets were that you'd see a 25 basis point cut in the Fed funds rate next week, 17th, 18th of September, when the FOMC meets. And about a 25% were guessing that, and I say guessing, that it would be a 50 basis point cut. By this morning, it was a 50% chance of a 25 basis point reduction and a 50% chance of a 50 basis point reduction. So the markets are assuming that interest rates will fall more forcefully sooner, as early as next week. And I should say that I saw one of my nicer 5.5% CDs that was callable is being called. The bank doesn't want to pay 5.5% on it anymore. They want to get lower rates, probably shave a whole percentage point off of what they're paying me when we buy a new CD on that one. So yeah, the market is expecting lower interest rates. Now, what does that mean? That means that the market is showing greater concerns over the potential of the overall economic outlook, or economic and political outlook. An increase in concerns over a recession imminently occurring, and also concerns about Washington fiscal gridlock, and a lot of other factors. I'll show you some inflation data that came out earlier this week in a second. So, we're seeing higher gold prices and silver prices, higher stock prices and bond prices, because the markets are more worried about the economic and political outlook. And in that environment, you should expect gold and silver prices to stay high. They'll come back off, and they may come off next week, especially if we only see a 25 basis point reduction in the federal funds rate on the 18th of September. It remains to be seen. Markets don't move in straight lines, but it's there. We've been talking about the potential for a recession late 2024 or early 2025, or in 2025, for a few years now, and there are indications that we're headed that way. And the Fed has seen those same indications, and they're likely going to reduce rates. We'll see how fast and how far they do that. One of the points I want to make, this is a long-term gold price, and you can see, there was 1973, 1974, the gold price spiked. It doesn't show up as being very big here, but if you look at it on a long scale, or if you look at it in actual dollar terms, it was very strong. You saw the price of gold go from around $45, $48 1972 or so, up to about $190. Fell back after that, but you did see gold prices rise sharply. Again, 1979 into 1980, and then the price came back down. You had a couple other blips over $400 in 1983 and in 1987. And then the big increase from 2001 into 2011, and then it came back down. The point I want to make is that, yes, gold prices usually rise sharply. They spike higher during times of economic and political stress. And then things get better and gold prices subside. They don't go back to where they were. After $190, it came down to like $120. After $850 on an intraday basis, it's $620 here, because these were looking at monthly averages. It came down to about $340. And after it got up to $1,800 some odd dollars in 2011, it came down to $1,040. So it doesn't come back to where it was, but it does subside when economic and political conditions get better. So unless you think it's the end of the world as we know it, World War III and all that other garbage, rhetoric, if you don't think it's the end of the world, you should expect gold prices at some point to subside when the economic and political stress gets reduced. It's just something to watch out for. We had that baked into our long-term price projections for gold and silver and other commodities. We have recessions. We have a recession coming up soon and that we're still projecting, and then an economic recovery. And then if you take our projections out 10 years or 25 years to the year 2050, which we do with our economic projections, you have more recessions and more recoveries, because that's the economic cycle, and we haven't broken it, we haven't fixed it, we haven't found a way around it. Silver prices, again, they're rising, they're lagging gold. They're lagging gold for a variety of reasons. It's the way it is. But they are showing strength. Our expectation, which I think we've talked about in previous videos, is that over the next 7 months, over the next 2 quarters, the fourth quarter of this year and the first quarter of next year, and even into the second quarter of next year, we think that silver prices will outperform gold prices, partly because of the smaller size of the silver market and partly because it has lag. And you will see a more forceful increase in prices with fewer dollars, investor dollars, going into silver. And we hope to talk about that soon in a video when we have an opportunity to focus on silver again. We saw CPI and PPI, U.S. Consumer Price Index and U.S. Producer Price Index, come out this week over the last 2 days. And for the August CPI, it's pretty much status quo. You can see here the maroon line, which is the all items excluding the more volatile food and energy, basically unchanged in August, around 3.2%, but coming down. And the all items, the headline inflation, coming down more sharply. That reflects the fact that petroleum prices and petroleum product prices, petroleum doesn't show up in the Consumer Price Index. Petroleum products do. Gasoline, heating oil, and other petroleum-based energy products show up in the Consumer Price Index because that's what consumers consume. They don't consume petroleum. Petroleum prices came off sharply last month, and that brought down the headline inflation to a much lower level. But if you take out that volatile energy price, you can see that while inflation, the price increases and the increases in prices and goods and services to consumers is down from its peak 3 years ago, but it is still higher than people want. And the higher CPI is predicated primarily on service price increases in transportation and in medical services. Looking at it on a month-to-month basis, you can see that August was pretty much a replay of July. And then if you look at it on a longer-term basis, CPI is still high, but it's back to the norm, if you will, of 1990 through 2008. On the one hand, that's a good sign. We can see that inflation has come down from 7.5%, 8%, 9%, depending on how you're measuring it, in 2021, 2022. And it's back to that norm rate. It's still higher than the Fed wants. It's a good thing that the prices are coming down. It's a bad thing in that insofar as prices are coming down because you're seeing weaker demand for goods and services and increased supplies of goods and services relative to demand. So one of the reasons people are concerned about a potential recession and a slowing down in the economy is that the prices are responding to higher interest rates and increased goods and tapping out to some extent of the debt-fueled consumption by not only people and not only the federal government, but also state and local governments and corporations. So clouds on the horizon, the near horizon. Now, I've said it before, and I'll say it again. I don't look at the Democratic Party as a party. I think it's more like a bunch of motorheads, sort of like looking at tricked out cars on a strip mall on a Saturday night. They just don't seem to be cohesive as a party. And what we saw in the debate this week between Donald Trump and Kamala Harris was that she missed a lot of opportunities to point out things that would have been of benefit to her argument about the current administration. Mr. Trump kept talking about how the country is going to hell in a handbasket and job creation is down and no one has jobs, and if there are jobs, they're being taken by illegal immigrants. But the reality is that there are 6.5 more million Americans, 4.3% of the workforce, working today than there were in February 2020, prior to the COVID lockdown. The employment is 4.3% higher than it was in 4 years ago. Now, jobs are created by companies. Fiscal policies only have so much influence on jobs creation, but it is important. What's really important is to understand the reality behind, or aside from, the nonsensical rhetoric that you hear from politicians. The reality is that the U.S. economy has 6.5% more workers today than it did in early 2020. Similarly, the U.S. economy is 11% larger than it was prior to the pandemic. The economy is not collapsing. Jobs are rising, economic output is rising, and this is real GDP. This isn't inflation-fueled growth. The U.S. economy is 11% larger than it was 4.5 years ago. Right? Now, on the other side, you have some bullshit coming out from the Republicans. Tariffs don't help. Just don't help. The U.S. government received about $80 billion in tariffs in 2023, and that's up a little bit from previous years. That's about 2% of the government's $4.4 trillion in revenue that it brought in last year. All of it, 100% of that $80 billion was paid by U.S. corporations that were importing goods. None of it, 0%, was paid by overseas corporations or governments. And those importers, those corporations that are importing that stuff, most of that $80 billion increased costs that they had to pay to the U.S. government was passed on to U.S. consumers. Tariffs don't help. They do have an inflationary pressure They do reduce demand, and there are all sorts of ways around it. The aftershave I use, cream, is created by a French company. It's manufactured in China. Tariffs have been placed on certain imports from China. So today you find that when you buy that aftershave, it says made in France and it's shipped from Portugal. But in fact, it's manufactured in China. There are all sorts of ways around tariffs, and everybody knows them. Let's just leave it there. It's a good book. Kind of big. It's kind of, well, Alan Greenspan wrote it, so it's, it's wordy, but it's well written. There used to be a joke in the 80s that when Alan Greenspan spoke, most people didn't have a clue what he was actually saying or meaning, but I did, and I did. It's an interesting book about him. He's a fascinating person. But on pages 89 through 91, he put in an anecdote, a little story that was very interesting. He talked about how in 1980, the powers that be in the Republican Party, and that was George Shultz, Caspar Weinberger, George H. Bush, and some other people, they knew that Ronald Reagan could and would win the presidency. They were doing some things like asking the Iranian Revolutionary Government to keep the U.S. hostages until Inauguration Day so that the hostages would hang over Jimmy Carter's head. In other words, they were violating various laws about the dealing with foreign adversaries of the U.S. government and interfering with U.S. foreign trade. By the way, all those people, including the Attorney General of the time, were found guilty, and they were all pardoned by George H. Bush, and the pardons were drafted by his young lawyer in the Justice Department, Bill Barr. That was his proof that he was a loyal soldier there. But on pages 89 and 91, there's this great discussion about how the powers that be in the Republican Party said, Ronald Reagan can win the presidency, but he's not presidential timber. We need a vice president who can run the country. And the concept of an executive presidency was born. And they wanted Gerald Ford, who was the ex-president, to be the vice president for Ronald Reagan. And Jerry Ford kept saying, no, that's totally inappropriate. And they said, no, you'll have all this power. He'll be like the chairman. He'll be the spokesman for the presidency, and you'll be the CEO actually running the country as the vice president. And Gerald Ford would say, no, that's probably unconstitutional. It's definitely inappropriate. And it would also be inappropriate for an ex-president to become vice president. I don't want to do that. So the powers that be went to Henry Kissinger and Alan Greenspan, and they said, hey, Gerald Ford likes you guys. He listens to you guys. Will you go talk to him and try to convince him to run for vice president? And they did, and he said no. And they said, report it back to George Shultz and company, George H. Bush, Caspar Weinberger. They said, go talk to him again. And this went on for like 2 or 3 times. And he discusses this all in his memoirs. It's worth reading. And finally, after like the 3rd time of Gerald Ford saying, I am just not going to do this. It's probably unconstitutional. George H. Bush said, okay, I'll be the vice president. And Alan knew this because he lived it and experienced it. But he also knew that it would probably be inappropriate for him to point this out in a prominent way. So he buried it in this multi-100-page memoirs on pages 89 and 91. It's really worth reading because it gives you some really good insights into American politics. Next week, we'll do a Tuesday and Friday videos, and then on Wednesday, we're doing an open forum for our clients, an open question and answer period. If you're a client, you can sign up to participate in this online seminar at info@cpmgroup.com, and you can send in questions ahead of time. And we've already received quite a few good questions that we're locking up to discuss. And if you aren't a client, you can go to info@cpmgroup.com and say, I want to become a client in the next several days because I want to participate in this. That's about what we have. You can go to our website. You can buy our books. You can see other free reads and videos. And you can send us emails if you want us to help you manage your precious metals and commodities exposure. That's all I have. Have a good weekend. Take care of yourself and those around you. Try to do something good for the world. And we'll talk to you next week.